ExamPrep.School, Missouri Crop Insurance Exam, Exam Code 31. There are 6 practice exams in this series. This video covers Practice Exam 1. The first 20 questions are free. In this video, we will be covering the following major categories for Practice Exam 1. Claim settlement practices, crop insurance, Director of Commerce and Insurance, general insurance terms and concepts, licensing requirements, marketing practices, multiple peril insurance. Let's walk through the format. I'll read each question and its choices. Let's get started. Question 1. Which of the following is one of the primary factors considered when setting the premium rate for an individual producer's multiple peril crop insurance policy? A. Soil type classification within the insured unit. B. Approved yield history for the insured unit. C. Regional market price differentials. D. Distance from the farm to the nearest processing facility. A countdown circle appears in the top right. Once it completes, the answer is revealed. You can pause at any time if you'd like longer to think. If you'd like additional practice covering more topics, see the description for our book. The correct answer is B. The correct answer is approved yield history for the insured unit, because the actual production history APH yield directly informs the actuarial expected loss and is used in the rate calculation. Reason A is not correct. Soil type classification is not used in RMA's actuarial rate setting for crop insurance premiums. Reason C is not correct. Regional market price differentials do not influence the rate. The price selection is a standardized price rather than a local differential. Reason D is not correct. Distance to a processing facility is not a factor in setting the crop insurance premium rate. Question 2. Which of the following best describes how an increase in a producer's actual production history, APH yield, affects their crop insurance premium rate per acre? A. It increases the premium rate because higher yields raise expected indemnities. B. It decreases the premium rate because higher yields lower the expected loss ratio. C. It has no effect on the premium rate since rates are administratively set. D. It depends on the selected harvest price election for the following year. The correct answer is B. The correct answer is that higher APH yields decrease the premium rate because the actuarial rate calculation uses approved yield to estimate expected losses, and higher yields reduce the loss ratio. Reason A is not correct. Higher yields reduce rather than increase expected indemnity, so premium rates decline instead of rise. Reason C is not correct. Rates adjust based on updated APH yields. They are not fixed without regard to yield history. Reason D is not correct. Price selection influences indemnity values but does not alter how APH yield affects the underlying rate per acre. Question 3. A farmer purchases multiple peril crop insurance on 120 acres of soybeans with a 70% coverage level and an approved APH yield at $8 bushel. The farmer plans to raise the coverage level to 80% while keeping other rating factors constant. What approximate percentage change in the annual premium cost should the farmer expect? A. Remain the same. B. Increase by about 8%. C. Decrease by about 12%. D. Increase by about 14%. The correct answer is D. The premium cost is directly proportional to the coverage level percentage. Raising coverage from 70% to 80% yields 80 minus 70 divided by 70, approximately 14.3% increase in premium. Reason A is not correct. Changing coverage level alters premium, so it does not remain unchanged. Reason B is not correct. The percent change from 70% to 80% is greater than 8%. Reason C is not correct. Raising coverage level increases rather than decreases the premium. Question 4. A producer currently insures 2 separate basic units of 50 acres each for corn under an APH policy. The producer is considering consolidating both units into a single enterprise unit while keeping all other rating factors constant. What is the most likely effect on the annual premium per acre? A. Decrease. B. Increase. C. Remain unchanged. D. Become dependent on individual subunit yields. The correct answer is A. Enterprise units combine acreage into a single risk pool, reducing variance and risk exposure. This risk reduction lowers the per acre premium compared to separate basic units. Reason B is not correct. Enterprise unit risk pooling typically reduces, not increases, premium rates. Reason C is not correct. Unit consolidation changes premium risk factors, so rates do not remain unchanged. Reason D is not correct. While yield variability influences risk, the key effect is an overall rate reduction, not dependency on individual subunit yields. Question 5. Under the federal multiple peril crop insurance program, to be eligible for catastrophic risk protection CAT coverage on an insurable crop, a producer must do which of the following? A. Elect a yield coverage level of 50% of the approved yield and a price election of 55% of the projected price, and pay a $300 administrative fee per crop per county. B. Elect a yield coverage level of 50% of the approved yield and a price election of 100% of the projected price without paying an administrative fee. C. Elect a yield coverage level of 55% of the approved yield and a price election of 55% of the projected price, and pay a $100 administrative fee. D. Elect a yield coverage level of 60% of the approved yield and a price election of 100% of the projected price with no administrative fee. The correct answer is A. The correct answer is that CAT coverage requires selecting 50% yield coverage, 55% price election, and paying a $300 administrative fee per crop per county under MPCI guidelines. Reason B is not correct. Electing a 100% price election without the required administrative fee does not meet CAT eligibility criteria. Reason C is not correct. A 55% yield coverage level and a lower fee do not satisfy the mandatory yield, price, and fee combination. Reason D is not correct. A higher yield or price election with no fee conflicts with CAT eligibility requirements for coverage and fees. Question 6. Under the federal multiple peril crop insurance program, buy-up coverage levels allow producers to select yield coverage levels up to what percentage of the approved yield? A. 55%. B. 65%. C. 75%. D. 85%. The correct answer is C. The correct answer is that buy-up coverage levels under MPCI extend up to 75% of the approved yield. Reason A is not correct. A 55% coverage level represents one buy-up option, but is not the maximum available yield coverage. Reason B is not correct. A 65% coverage level is available but does not represent the highest possible buy-up coverage level. Reason D is not correct. An 85% coverage level exceeds the maximum percentage permitted under buy-up coverage options. Question 7. A corn producer has two separate crop insurance policies on the same acreage: yield protection and revenue protection. In a year when actual yield is 90% of the APH and the harvest price ends up 15% above the projected price, which policy will result in an indemnity payment? A. Revenue protection. B. Yield protection. C. Area revenue protection. D. Actual production history insurance. The correct answer is B. The policy that triggers an indemnity for a yield shortfall regardless of a higher harvest price is yield protection, since it uses the price selection and pays when yield falls below the APH. Reason A is not correct. This policy covers revenue shortfalls but does not pay when actual revenue exceeds the guarantee due to higher prices. Reason C is not correct. This coverage uses county-level data rather than an individual farm's yield, so it would not apply here. Reason D is not correct. This is not a standard crop insurance plan, and therefore cannot trigger an indemnity. Question 8. A wheat producer has a revenue protection policy with an APH of 60 bushels jars acre, a 75% coverage level, a projected price of $5, and selects a price selection of $4.75. If the harvest price drops only to $4.85, what outcome reflects the effect of the chosen price selection? A. It has no impact on the revenue guarantee but reduces the policy premium. B. It lowers the revenue guarantee compared to using the projected price, resulting in reduced indemnity potential for price declines. C. It increases the revenue guarantee above the projected price level, raising the threshold for an indemnity. D. It reduces both premium and the revenue guarantee equally with no net effect on indemnity payments. The correct answer is B. Selecting a price selection below the projected price reduces the revenue guarantee, thereby lowering the maximum indemnity for price declines compared to using the projected price. Reason A is not correct. A price selection does affect the revenue guarantee, not just the premium. Reason C is not correct. Choosing a lower price selection can never increase the revenue guarantee above the projected price. Reason D is not correct. The reduction in premium is not matched by an equal reduction in both guarantee and indemnity potential. Question 9. A soybean producer with a 70% revenue protection policy adds the supplemental coverage option SCO. At harvest, the county yield is 80% of the expected level, while the producer's actual yield is 75% of APH. Which feature of the SCO explains why an indemnity payment is made? A. It adjusts the price selection upward to compensate for market fluctuations. B. It pays only after the producer's individual yield falls below the coverage level. C. It provides area-based coverage triggered by county-level yield shortfalls regardless of individual farm performance. D. It increases the underlying coverage level to 86% for all units. The correct answer is C. The SCO is an area-based endorsement that triggers indemnities when county yields fall below the threshold, regardless of an individual farm's yield results. Reason A is not correct. The SCO does not modify the price selection. It provides area-based coverage. Reason B is not correct. The SCO uses county data, not individual farm yields, to determine indemnity. Reason D is not correct. The SCO does not universally raise the coverage level. It supplements area losses above the underlying policy. Question 10. Under a federal crop insurance policy, the term liability is defined as which of the following? A. The total dollar amount of insurance coverage available for an insured crop. B. The percentage of the approved yield selected by the insured. C. The number of bushels per acre guaranteed under the policy. D. The price per unit of production elected by the insured. The correct answer is A. The liability represents the total dollar amount of coverage provided by the policy, determined by multiplying the approved yield, price selection, and insured acreage. Reason B is not correct. This describes the coverage level, which is the percentage of yield coverage selected, not the total dollar amount of coverage. Reason C is not correct. This defines the production guarantee, which is yield-based rather than a dollar value of coverage. Reason D is not correct. This refers to the price selection, which is the dollar value per unit, not the total coverage amount. Question 11. A corn farmer plants and insures 150 acres under an MPCI policy, but fails to submit the required acreage report by the policy's final acreage reporting date. Under standard policy provisions, what is the most likely consequence? A. A 10% late filing penalty will be applied to any indemnity. B. The policy will be canceled retroactively to the planting date. C. Indemnity will be denied for the unreported acres. D. Only prevented planting coverage remains in effect. The correct answer is C. Failure to file the acreage report by the deadline voids coverage for those acres, so the insurer is not obligated to pay an indemnity on unreported acreage. Reason A is not correct. There is no specified late filing penalty percentage. The policy simply denies indemnity for unreported acres. Reason B is not correct. Retroactive cancellation is not a standard remedy. Coverage isn't voided entirely but only for the unreported acreage. Reason D is not correct. Prevented planting coverage is not maintained if the general acreage report is untimely. It also requires timely reporting. Question 12. An insured under an MPCI policy fails to submit the required annual production report by the policy's reporting deadline. How will the insured determine the yield for indemnity purposes? A. Apply prevented planting provisions to calculate a default yield. B. Rely on the first available APH table value without adjustment. C. Reason B is not correct. This is too broad and includes sensitive psychiatric details to a non-treatment volunteer, exceeding what is necessary for care coordination. D. Use transitional yield values specified in the policy. The correct answer is D. When the annual production report is not filed on time, the insurer substitutes transitional yield values as defined in the policy for final indemnity calculations. Reason A is not correct. Prevented planting provisions apply only to prevented plant scenarios, not to late production reports. Reason B is not correct. The policy requires transitional yields rather than unadjusted APH values when reports are missing. Reason C is not correct. There is no penalty percentage in the policy. It specifies use of predetermined transitional yields. Question 13. Under the federal multiple peril crop insurance policy, what does the term liability refer to? A. The insurer's maximum dollar indemnity payable for a loss on a crop unit. B. The dollar value of the production guarantee based solely on approved yield and acreage. C. The amount the insurer pays after deducting the policy premium from the indemnity. D. The maximum amount recoverable by additional insureds under the policy. The correct answer is A. Liability is defined as the insurer's maximum dollar indemnity obligation per crop unit, calculated using acreage, approved yield, coverage level, and price election. Reason B is not correct. It describes the production guarantee's value but omits adjustments for price selection and coverage level. Reason C is not correct. It conflates liability with net indemnity after premium deductions, which is not the policy definition of liability. Reason D is not correct. It misattributes liability limits to additional insureds, whereas liability concerns the insurer's total loss exposure. Question 14. An insured has two separate wheat fields with different approved yields and coverage levels. Field A is 150 acres with an approved yield of 100 bushels per acre and a coverage level of 75%. Field B is 50 acres with an approved yield of 120 bushels per acre and a coverage level of 65%. If the price election is $5 per bushel for both fields, what is the total policy liability under the MPCI policy? A. $78,750. B. $56,250. C. $84,000. D. $75,750. The correct answer is D. The total policy liability equals the sum of each field's liability. Field A, 100 bushels multiplied by 0.75 equals 75 bushels guarantee. 75 bushels multiplied by $5 equals $375 per acre. $375 multiplied by 150 acres equals $56,250. Field B, 120 bushels multiplied by 0.65 equals 78 bushels guarantee. 78 bushels multiplied by $5 equals $390 per acre. $390 multiplied by 50 acres equals $19,500. Combined liability equals $56,250 plus $19,500 equals $75,750. Reason A is not correct. That calculation incorrectly applied the first field's coverage level to both fields. Reason B is not correct. That result reflects only the first field's liability, neglecting the second field. Reason C is not correct. That figure assumes an 80% average coverage level for both fields instead of the specified levels. Question 15. Under Missouri law, which of the following best describes the definition of an insurance producer? A. An underwriter who assesses risk and establishes policy terms on behalf of an insurer. B. A person who adjusts or investigates insurance claims for compensation. C. A business entity that provides consulting services to insurers without selling insurance. D. An individual who sells, solicits, or negotiates insurance contracts for compensation. The correct answer is D. The correct answer defines an insurance producer as someone required to be licensed to sell, solicit, or negotiate insurance. Claim adjusters, consultants, and underwriters perform distinctly different functions and are not categorized as producers under Missouri statutes. Reason A is not correct. Underwriters are insurer employees who set policy terms and are exempt from producer licensing. Reason B is not correct. This describes a claims adjuster role, which requires an adjuster license rather than a producer license. Reason C is not correct. Consulting services without selling insurance do not fall under the producer definition. Question 16. Which of the following activities requires a Missouri insurance producer license? A. Evaluating and adjusting property loss claims for a fee. B. Soliciting applications for health insurance and explaining policy benefits for compensation. C. Underwriting insurance applications as an employee of the insured. D. Advising clients on coverage disputes as a licensed attorney. The correct answer is B. Soliciting applications and discussing policy terms for compensation is an activity that requires a producer license under Missouri law. Claims adjustment, insurer underwriting, and legal advice by an attorney are either separately licensed or exempt activities. Reason A is not correct. Property loss adjusting requires a claims adjuster license, not a producer license. Reason C is not correct. Underwriting by an insurer's employee is exempt and does not require producer licensing. Reason D is not correct. Licensed attorneys providing legal advice on policies are exempt from producer licensing. Question 17. A property and casualty insurance producer licensed in Missouri wants to begin soliciting crop hail and multiple peril crop policies to local farmers. Under Missouri licensing requirements, which line of authority must the producer obtain before selling these crop insurance products? A. Property insurance line of authority. B. Surplus lines license. C. Crop insurance line of authority. D. Life insurance line of authority. The correct answer is C. Missouri requires a specific crop insurance line of authority for any producer offering crop hail or multiple peril crop policies, distinct from standard property, sod, casualty, or other lines. Reason A is not correct. Property Insurance Authority covers general property risks, but does not include the specialized crop insurance program. Reason B is not correct. A surplus lines license pertains to non-admitted insurers and does not grant authority to write approved crop insurance products. Reason D is not correct. Life Insurance Authority relates to mortality and annuity products, which are unrelated to crop insurance contracts. Question 18. Under Missouri law, which of the following criminal convictions will automatically render an applicant ineligible for an insurance producer license? A. Conviction of misdemeanor. Disorderly conduct in public. B. Conviction of misdemeanor. Trespass on private property. C. Conviction of felony driving under the influence. D. Conviction of felony embezzlement of client funds. The correct answer is D. Under Missouri law, felony convictions involving dishonesty or breach of trust, such as embezzlement of client funds, permanently disqualify an applicant. The other offenses do not meet the statutory disqualification criteria. Reason A is not correct. A misdemeanor disorderly conduct is neither a felony nor an offense involving dishonesty or breach of trust. Reason B is not correct. A misdemeanor trespass does not involve a felony-level dishonest or trust-related offense. Reason C is not correct. A felony DUI, while serious, does not constitute dishonesty or breach of trust under the licensing statute. Question 19. When submitting an initial Missouri insurance producer license application, which of the following must accompany the completed application form? A. Proof of errors and omissions. Insurance coverage. B. A letter of professional recommendation from a licensed insurer. C. A set of fingerprints for background checks. D. A certificate of deposit instead of a surety bond. The correct answer is C. Missouri statute requires applicants to submit fingerprints with their initial license application to facilitate state and federal background checks. The other items are not mandated as part of the application packet. Reason A is not correct. Errors and omissions insurance proof is not a prerequisite for the license application. Reason B is not correct. A professional recommendation letter is not required by Missouri licensing statutes. Reason D is not correct. A certificate of deposit in lieu of a surety bond is not required for individual producer applications. Question 20. Jordan is applying for a Missouri property and casualty producer license and must complete the required background check. Which action best satisfies the state's fingerprinting requirement? A. Submitting a standard ink fingerprint card processed by a local police department. B. Submitting self-taken ink fingerprints on an FD 258 form by mail. C. Electronically submitting fingerprints through the state's approved vendor within 30 days of application. D. Mailing ink fingerprint cards directly to the Department of Commerce without using an approved vendor. The correct answer is C. The state requires applicants to use the approved electronic fingerprinting vendor and submit prints within 30 days of filing the license application to ensure accurate and timely background checks. Reason A is not correct. Local law enforcement processed ink cards are not accepted because the state mandates use of its approved vendor for consistency and security. Reason B is not correct. Self-taken ink prints on FD 258 forms are not permitted. Prints must be captured by an approved vendor using electronic scanning. Reason D is not correct. Direct mailing of cards to the department bypasses the required chain of custody and vendor verification process. Enjoyed this practice test? Tap like, hit subscribe, and share it with a classmate. Got a question we should tweak? Comment below. We read them all. Find full practice exam books in the description or at ExamPrep.School.